Welcome to the deep dive. Have you ever just felt completely swamped by all the financial info out there?
Oh, constantly.
Right. Articles, research reports, news flashes. It's like, it's overwhelming.
Like trying to drink from a fire hose, definitely.
Exactly. And you end up feeling more confused, not less. But what if there was like a guide, a timeless approach to cut through all that noise and figure out what really matters for investing?
Mm-hmm.
Well, that's precisely what we're doing today. We're taking a deep dive into a true classic, Benjamin Graham and David Dodd's security analysis. Specifically, we're zeroing in on the foundations, the introduction, and part 1. So that's chapters 1 through 5.
The real bedrock stuff.
The bedrock, yeah. And our mission for you listening is to pull out the essential lessons, maybe some surprising facts, and those principles that just last. The ones that make this, 75-year-old book still incredibly relevant for your investing today.
And it's fascinating, isn't it? Because this book, it didn't just tweak finance.
Yeah.
It fundamentally changed how people thought about markets. It came out of the Great Depression. Talk about uncertainty. And yet, its core wisdom guided generations of investors, some of the biggest names ever.
Mm-hmm.
So we'll explore why it's still seen as, the definitive word on fundamental analysis, and how its ideas can help you navigate these, let's face it, unpredictable markets, learn faster, and avoid that information overload we started with.
Okay, so let's start with the sheer weight of respect this book commands, even now. If you look at the praise for the 6th edition, it's a who's who of investing giants.
It really is.
We're talking David Swensen from Yale, Jack Meyer, Jamie Dimon at JP Morgan Chase, Brian Rogers from T. Rowe Price.
Heavy hitters.
Totally. Daniel Auck, Morris Smith, Fidelity Magellan fame, Mason Hawkins, Andre Perrault from Harvard Business School. It's not just a polite nod, is it? This is serious endorsement.
It's profound, yeah. And when you, boil down what they're all saying, a few key themes really jump out. First is this idea of adaptability. Yeah. Swensen says the 6th edition disproves. 'Tis best to leave well enough alone. He loved how it bridges the 1930s and the new millennium.
So it's not just a relic.
Not at all. It's been updated, kept relevant. Jamie Dimon calls it more essential than ever as a learning tool and reference book. You keep going back to it.
Okay.
Then, the second big theme, and this is crucial, is recognizing that human behavior is key.
The psychology.
Exactly. Brian Rogers points out an understanding of human behavior is a critical part because tech changes, markets change, but people, fear, greed, that's constant.
Right.
Morris Smith says its principles have withstood all kinds of market conditions and 75 years of scrutiny, making them ever more relevant. Why? Because human reactions don't fundamentally change.
That makes sense.
And Perrault sums it up nicely. While capital markets change, basic investor traits are not. So applying these principles gives you an edge. It's a defense against our own worst impulses, really.
But this is where it gets really interesting. The ultimate stamp of approval, maybe? Warren Buffett.
The oracle himself.
Right. He basically treats this book like scripture. He says it's one of only 4 books in his massive library written over 50 years ago that he'd still find hugely valuable reading for the first time today.
Think about that. Only 4. Out of everything he's read.
It's incredible.
And his connection, it's personal.
Yes.
Deeply personal. He didn't just read it. He studied under Graham and Dodd at Columbia in the early 50s.
Wow, I didn't realize that.
Yeah. He says point blank, the book and the men changed my life. He'd read tons of investment books before, called them none were really useful, until this one.
Huh.
It literally became, his words, the bedrock upon which all of my investment and business decisions have been built. That's foundational.
That's huge.
And what's amazing, what Buffett really emphasizes, is their generosity. Graham and Dodd taught thousands of potential competitors like him.
They shared the secrets.
Totally. Used current examples in class, real-time stuff. Buffett saw it as teaching not just how to invest wisely, but how to live wisely, giving back knowledge.
It says a lot about them.
It really does. And get this. In 2000, Dodd's daughter gave Buffett her father's original 1934 edition, full of his handwritten notes for the next version.
No way.
Yeah. Buffett said, "No gift has meant more to me." It's like this direct link to his intellectual roots.
That's an amazing story. Okay, shifting gears slightly, but still on relevance, Seth Klarman. Huge name in value investing today. He wrote the preface for the 6th edition.
Right. The Timeless Wisdom of Graham and Dodd. Apt title.
And he really hammers home why this book still matters, right?
He really does. He calls Graham and Dodd these assiduous and unusually insightful thinkers who brought order to the, uncharted financial wilderness of their time. The Depression was chaos.
Right.
And Klarman says security analysis is still this invaluable roadmap for navigating today's markets, unpredictable, volatile, sometimes treacherous.
So a map for treacherous terrain.
Exactly. He calls it the Bible of value investing. Incredibly thorough, teeming with wisdom. He acknowledges, sure, many examples are obviously dated.
1930s companies, yeah.
Right. But he stresses, their lessons are timeless. That's the key takeaway. Markets morph in unimaginable ways, Klarman says, but the Graham and Dodd approach, still remarkably applicable. It's about the underlying thinking, the framework, not just the specific stocks from 1934.
Okay, so all this high praise, this timeless wisdom, what does it actually boil down to for us? Trying to figure things out today. Klarman offers a really neat definition of value investing.
Yeah, it's brilliantly simple on the surface.
He calls it the practice of purchasing securities or assets for less than they are worth. The proverbial dollar for 50 cents. Sounds easy.
If only.
Yeah.
But baked into that simple idea is the absolute cornerstone.
Yeah,
the margin of safety.
The buffer.
The buffer, exactly. It's your room for error, for bad luck, for just the general craziness of economies and markets. Is the gap between the price you pay and what it's really worth.
And it's not just a calculation, is it?
No, it's way bigger than that. It's a whole philosophy. It demands, deep fundamental analysis, focusing on long-term results, actively limiting your risk, and crucially, resisting that herd mentality.
Which is hard.
So hard. And it stands in total contrast to what Klarman calls speculators.
The gamblers.
Kind of.
Yeah.
They're chasing quick money, focusing on the stock price moving, not the business value underneath. They disconnect the two. They ignore the downside. You see a lot in bull markets, right? Everyone looks like a genius.
And until they're not.
Exactly. Value investors have this built-in risk aversion. They feel the pain of loss more than the pleasure of gain. That's key. And fundamentally, they see securities not as betting slips, but as actual ownership stakes or claims on real businesses.
Like owning a piece of a corner store, just bigger scale.
Precisely. Think about like the junk bond blow-up in the late 80s. Campo buying Federated department stores.
Vaguely remember that.
The bonds they issued needed Federated to pay $600 million a year in interest. Problem. The company only earned $400 million. Basic Graham and Dodd analysis screams no.
You can't pay out more than you make.
Right. So, surprise, surprise. Federated goes bankrupt 2 years later. The bond buyers, they were speculating, not investing, and ignored the basic business reality. They paid the price.
Ouch. A painful lesson. And Graham and Dodd themselves had this famous analogy, right? About the market, not a weighing machine.
Ah, yes. Classic. The market, they said, isn't a weighing machine accurately telling you the intrinsic value. No, it's a voting machine.
Voting machine, meaning?
Meaning its choices, the prices, are driven partly by reason, sure, but also hugely by emotion, popularity, sentiment.
Like an election.
Exactly. And the implication is massive. It means the market can be quite inefficient short term. You get these great deviations between price and underlying value, which means, and this is core Graham and Dodd, the price is frequently an essential element.
Yeah.
A stock might be a good investment at one price, but a terrible one at another.
So price matters a lot.
Hugely. And people who see the market as that weighing machine, who just trust the ticker price, they're often just part of the emotionally driven herd.
Chasing momentum.
Right. But if you see it as that sentiment-driven popularity contest, you're positioned to take advantage of the extremes. When the voting goes nuts, either too optimistic or too pessimistic.
That requires patience, though.
Patience is non-negotiable. You wait for the weighing machine aspect, the true value, to eventually override the short-term voting.
And finding that true value, that weight, that brings us to intrinsic value, famous Graham and Dodd term. But they never quite pinned it down with a formula, did they?
No, and that's really important. They called it the worth of an enterprise to one who owns it for keeps. So it's about long-term ownership value, not just a fleeting market price.
So how did they describe it then?
Well, in Chapter 1, they say it's that value which is justified by the facts, assets, earnings, dividends, definite prospects, as distinct from market prices distorted by manipulation or psychological excesses.
Okay, facts, not hype.
Right. But they admit it's elusive. Not precise, like a stock quote. They shot down older ideas, too, like just using book value, what the assets cost minus debt. That proved almost worthless sometimes. A company could have lots of assets but be a dying business.
Makes sense.
And the idea that just earning power is enough, also flawed. because that relies on confidently predicting the future, which,
Is hard.
very hard. They used J.I. Case in 1933 as an example. Stock price $30, asset value $176 per share. Looked great. Average earnings over 10 years were $9.50.
Seems decent.
But the individual years swung wildly. Big profits, big losses.
Yeah.
Graham and Dodd said that average was just an arithmetical resultant from 10 unrelated figures. You couldn't reliably predict the future from that volatile past. Too much uncertainty.
So if it's not book value, not just projecting past earnings, what is the analyst supposed to do?
Their practical goal, they said, isn't to find the exact intrinsic value. It's just to establish either that the value is adequate or else that the value is considerably higher or considerably lower than the market price.
Find the big mispricings.
Exactly. They have this great analogy. You can tell if a woman is old enough to vote without knowing her exact age, or if a man is overweight without knowing his exact weight.
Approximate but good enough for a decision.
Precisely. It's about approximate measure. And they stress the flexibility of the concept. Intrinsic value is a range, and that range gets wider the more uncertain things are. But even a fuzzy range can justify action if the price is way outside it.
Like value is $80, $120, price is $30, clear buy.
Exactly. You don't need the exact number. They did mention special cases like arbitrage or liquidations where value could be more definite, but those are rare. The main idea is value is an anchor, even if it's a slightly fuzzy one, that the price should eventually move towards.
Okay, that distinction between price and value and intrinsic value being a range, that really shifts how you look at things. So we know what they were looking for. How did they suggest actually finding it? They talked about 3 functions for the analyst, right? Descriptive, selective, critical.
Yeah, it's a systematic process. First, descriptive. That's just gathering the facts.
The data dump.
Pretty much. Financial statements, strengths, weaknesses, comparing it to peers, looking at observable trends is the homework, laying the groundwork. You see this in like those big financial data manuals.
Okay, step 1, get the facts.
Step 2, selective. This is where judgment comes in. You're not just listing facts, you're making a call. Buy, sell, hold, exchange.
Making the recommendation.
Right. And their examples really show the thinking, like rejecting St. Louis to San Francisco Railway Preferred in 28 because earnings didn't consistently cover charges and dividends by enough. Safety first, always.
Adequate coverage.
Key principle. But then contrast that with Owens Illinois class bonds in 32. Selling cheap, yielding 11% during the Depression, but earnings easily covered interest, current assets covered the bonds. Analysis says, buy. Attractive terms on a solid company, even in bad times.
Right.
And for stocks, price is everything. Right aeronautical, $8 in 1922. Good buy. Strong earnings, cash backing. Same stock at $280 in 1928. Bad buy. Pure speculation on conjectural future prospects. Price completely detached from value.
Same company, different prices, different decision.
Absolutely critical lesson.
Yeah.
And the final function? Critical. This is about evaluating soundness, challenging assumptions, like the Interborough Rapid Transit bonds in 33. The 7% notes and 5% bonds sold at the same price, but the 7s had way better collateral, more the 5s backing them, and were technically senior. Analysis says the 7s are intrinsically worth more. Dig into the details.
So describe, select, critique. A clear process.
Very. It forces discipline.
Okay, and then in Chapter 2, they give this other framework, 4 factors in every decision: the security, the price, the time, and the person. Why that order? Starting with the person seems unusual.
It's about building from the specific context outwards. The person comes first because investing isn't universal. What works for a risk-tolerant business owner is totally wrong for a widow needing stable income.
Know thyself.
Exactly.
Yeah.
Your financial situation, your knowledge, your temperament, it all matters. Analysis might be impersonal, but applying it has to be personal.
Okay, then the time.
Right. Market conditions change. A bond yielding 5% looks good one year, bad the next. If overall rates rise, company outlooks shift. You need to be aware of the context, the economic environment. Analysis seeks timeless principles, but application happens in time.
Makes sense. Then the price.
Crucial. We touched on this.
Yeah.
Price is integral. Maybe less so for super high-grade bonds, but for stocks, foundational. They hammered the 1920s new era, thinking that ignored price. That AT&T convertible bond example selling over $200 in 29s. Fundamentally safe, yes, but extremely risky at that price. It lost half its value. Price matters.
Can't overpay, even for quality.
Precisely. And finally, the security itself, which breaks down into the character of the enterprise, what kind of business is it, and the terms of commitment, what deal you're actually getting.
And this leads to that really counterintuitive point you mentioned about attractive companies versus attractive terms. Most people would go for the good company, even if the price is high. But Graham and Dodd suggested something different for the analyst.
Yeah, this is a huge differentiator. The popular view, the amateur view, is buy quality at any price, basically. The thinking is you lose less money overpaying for a great company than buying a low-grade one cheap.
Seems logical on the surface.
For someone who can't do the analysis, maybe. But for the analyst, the expectation is different. You judge quality by examination, not reputation. And you might deliberately sacrifice certain definite degrees of quality if you get adequate quality at a really attractive price.
Okay.
So 2 principles emerge. 1, untrained buyer. Stick to quality, don't touch low-grade stuff. 2, analyst. Nearly every issue might conceivably be cheap in one price range and dear in another. Price is always the variable.
Even for the best companies.
Even for the best. Their examples were sharp, like NYC Real Estate preferred in 29. Sound enterprise, but maybe unattractive terms if the yield was too low compared to alternatives. Contrast that with Brooklyn Union Elevated Railroad bonds in 32. Terrible industry, right?
Yeah.
Trolleys losing to cars.
Yeah, dying business.
But the terms were attractive. First claim on surprisingly stable earnings, good yield. It was a satisfactory investment despite the bad industry because the price and terms were right. Terms can trump industry.
Wow.
And they showed even the best companies are vulnerable. Westinghouse. World beater in 29, selling for less than cash and receivables 2 years later. A&P Growth Miracle in 29, stock down 90% by 38, selling for less than its cash. Reputation is no shield against overpaying. Price and terms matter.
That's a powerful warning. So, okay, if analysis is so potent, why isn't everyone rich? Graham and Dodd saw obstacles, right? Data, the future, the market.
Exactly. 3 main hurdles. First, inadequate or incorrect data. Honestly, this is less of an issue now thanks to the SEC. Back then,
Yeah.
huge problem. Companies hid things. They even mentioned the irony of Dun & Bradstreet, the info company, not sharing its own earnings.
That's rich.
Isn't it? But disclosure is much better today. The second obstacle, though, is timeless. Uncertainties of the future. The future's unpredictable. Analysis has to use the past as a rough guide, but that's riskier for volatile businesses or common stocks compared to stable businesses or senior securities with buffers.
The past isn't always prologue.
It definitely isn't. And the third obstacle, this is the big one, the irrational behavior of the market. You can't predict it, you can't control it, but your success depends on it. Prices get driven by speculation, by people's sentiments and decisions.
A voting machine again?
Back again. Partly reason, partly emotion. And the real danger is the hazard of tardy adjustment. Your analysis can be right. A stock is undervalued, but the market might ignore it for ages.
And things could change in the meantime.
Precisely. New factors come along before the price corrects. So the analyst needs to prefer situations less prone to sudden change, or where there's enough interest that the market will eventually react. It's a constant fight against irrationality and impatience.
Which brings up another key point they made. Analysis works better for investment than speculation. Why can't sharp analysis just make you a great speculator?
Good question. They gave several reasons. First, the basic mechanics of speculation work against you. Commissions, interest on margin, the bid-ask spread. It's costly. Plus, statistically, the average loss tends to exceed the average profit unless you're incredibly disciplined with a specific method. The house edge, basically.
The odds are against you.
Fundamentally, yes. Second, in speculative plays, the underlying value itself can change swiftly and suddenly. That risk of the facts changing before the price adjusts. Way higher in speculation. Your analysis could be outdated almost instantly.
Right.
Third, those unknown factors. Insiders often have an edge. The idea that good and bad news will just cancel out doesn't always hold when someone knows something you don't.
The playing field isn't level.
Often not. And their most profound point, I think, is about analysis losing value as chance increases. The roulette wheel analogy is brilliant.
Remind me of that one.
Imagine a wheel slightly rigged in your favor. Small edge. If you bet evenly across all numbers, you'll likely win moderately over time. That's like sound investing with an analytical edge.
Okay.
But if you bet all your money on one number, your tiny edge becomes almost irrelevant compared to pure luck. You could be right about the odds, but still get wiped out by chance.
Like putting all your eggs in one very risky basket.
Exactly. And we saw this with long-term capital management LTCM in 98. Nobel laureates, complex models, supposed edge, but highly leveraged bets were linked. When Russia defaulted, the whole thing collapsed. They ignored the power of chance and correlation.
Wow. So the lesson is...
Analysis is an adjunct or auxiliary, not the primary guide in speculation. It speaks with authority only when chance plays a subordinate role. For investing, indispensable. For speculation, use with extreme caution.
That's a really clear line they drew. Analysis for investment, not really for speculation. Okay, so if we're focused on investment analysis, let's get into the nitty-gritty. They split things into quantitative and qualitative factors. What's the difference, and why did that split matter so much to them?
It's absolutely central. Quantitative is the statistical exhibit. Numbers, balance sheet stuff, assets, liabilities, income statement, earnings, dividends, operating stats, things you can measure.
Our data.
Right. Graham and Dodd felt these were fewer in number, more easily obtainable, and much better suited to the forming of definite and dependable conclusions. Numbers offered objectivity.
Makes sense. And qualitative.
That's the fuzzier stuff. Nature of the business, its position in the industry, physical characteristics, quality of management, the outlook.
The story.
Kind of, yeah. And the problem is, it comes from miscellaneous sources of greatly varying dependability, often just opinion. They stated flat out, qualitative factors resist even reasonably accurate appraisal. You can't easily put a number on good management or positive outlook.
Right. How much is charisma worth?
Exactly. And judging how these fuzzy factors should affect the price. Almost impossible. This is where market excesses happen, prices based on hopes, on qualitative stories, not hard facts. So their stance was clear. Analysis focuses on values supported by facts, not expectations. The future, especially based on qualitative stuff, is a hazard, not where you find your justification. Anchor in the numbers.
That's a really strong stance, especially compared to today where story stocks and visionary CEOs get so much attention. They specifically warned about focusing too much on earnings trends or management quality, didn't they?
Oh, big time. They saw those as major pitfalls. Take the trend of future earnings. Their warning was blunt. A past trend is fact. A future trend is just an assumption. And trends carried far enough into the future will yield any desired result. You can make numbers say anything if you extrapolate wildly.
Like drawing a line on a chart forever upwards.
Exactly. Lowenstein uses Microsoft in the late 90s. Great earnings growth, 95 to 2000. Analysts just drew that line onwards, pushed the stock sky high. Then earnings dipped in 01-02, stock tanked. The trend wasn't destiny.
Ouch.
And then there's the factor of management. They were so skeptical. Objective tests of managerial ability are few and far from scientific, they said. And the market tends to value the management factor twice.
Double counting. How?
You pay a high price because earnings are good, thanks to management, plus you pay an extra premium just for good management itself. Lowenstein gives the Coke example under Goizueta in the 90s.
The star CEO.
Right. Stock at 45 times earnings. Huge faith in him. One analyst said Coke had absolute control over near-term results. Turned out to be hype. Some earnings were even engineered with accounting tricks. The stock went nowhere for years after. Management quality is hard to judge and easy to overpay for.
So, if not trends or charismatic CEOs, what qualitative factor did they think mattered?
Inherent stability. That was the key. Does the business itself resist change? Is it dependable?
Like boring businesses might be better.
Sometimes. Their example was Studebaker versus First National Store's preferred stock in 32. Studebaker, the car company, had better staff at that moment. But First National, the grocery chain, inherently more stable. People always need food. Diversified stores, quick inventory turnover.
Less susceptible to disruption.
Exactly. The car industry, even then, was prone to extraordinary variations, fickle tastes, competition. The analyst, they argued, needs to look beyond the numbers to the fundamental, durable character of the business. Is it built to last?
That makes a lot of sense. Look for resilience. Okay, so Graham and Dodd were famous for digging deep. What kind of information did they actually use back then? It must have been way harder to get data.
Oh, incredibly harder.
Yeah.
A completely different world. Back then, you relied on company reports, but they were inconsistent. Railroads gave monthly data, utilities maybe quarterly, but many industrial firms. Only annual reports, often hiding sales figures. U.S. Steel was good, but even they sometimes stopped reporting monthly earnings if things looked bad.
Less transparency.
Way less. Official reports, often the best source. Regulatory commissions, like for utilities or railroads, forced companies to disclose more details than they gave stockholders.
Interesting. Go to the regulator.
Sometimes you had to. Publications, things like the Survey of Current Business, trade journals for specific industries like auto or oil, NYSE listing applications, which were surprisingly detailed before the SEC existed, and the big statistical services, PORS, Moody's, Standard Statistics. And the Commercial and Financial Chronicle newspaper was key.
Lots of paper.
Lots of digging. Direct inquiry. Stockholders had rights, but sometimes had to demand info. And interestingly, Graham himself didn't trust executives much, didn't like visiting companies, feared being swayed by personality over facts.
Wow. Okay, fast forward to now. What's changed?
Everything. Lowenstein calls it a surfeit of information. We've gone from scarcity to overload. The internet gives unlimited info, but quality varies wildly.
The signal-to-noise problem.
Huge problem. But the big structural change is SEC regulations. Mandatory 10Ks, 10Qs, prospectuses. Transparency is vastly higher. Sales figures are standard now.
So the raw data is there.
It is. And the focus has shifted too. Cash flow statements are massive now. Weren't required back then, but today. Indispensable, Lowenstein says. Why? Because reported earnings can be an accounting fiction. But they can't manufacture cash.
Cash is king.
Absolutely. Think Sunbeam, Lucent earnings looked okay, cash flow didn't. Big red flag. Modern analysts live by the cash flow statement.
What about the balance sheet? Still important.
Yes, but differently. Maybe less critical for finding upside today because of inflation and higher returns on capital distorting historical costs, but still crucial for spotting deterioration or vulnerability. Rising inventory, slow receivables, too much debt, cash disappearing.
Yeah.
Danger signs. So the challenge for you today isn't finding data, it's filtering it. Finding the relevant, reliable stuff amidst the noise. And true exclusive information, competitive intelligence, is still golden. Talking to former employees, suppliers, competitors, even that anecdote of the broker learning about Jones Soda from Starbucks baristas.
Ah, grassroots research.
Whatever works. The key is weeding out the irrelevant, finding what matters, and verifying it against reliable disclosures.
That's a fascinating contrast, the information then versus now.
Okay, finally, let's look at how Graham and Dodd rethought how we even classify investments. They argued the old labels bonds, preferreds, common stocks could be really misleading. This goes right back to their substance over form idea, doesn't it?
Absolutely. It's core to their thinking. Their critique was sharp. First, they demolished the idea that just because something is called a bond, it's automatically safe.
Bond form identified with safety. Unsound, they said. Exactly. Safety comes from the issuer's ability to pay, not the label. A bond from a brand new company with no assets or profits. It's no safer than stock in that company, maybe even worse, because there's no upside.
Right. The label doesn't guarantee anything.
And they pointed out the failure of titles to describe issues with accuracy. So many weird securities, even then. Income bonds, convertibles, warrants, participating preferreds. They highlighted those insidious associated gas bonds that converted to preferred at the company's option.
Wait, the company decided? Not the bondholder.
Right. So if the stock soared, the company could force conversion, capping the bondholder's gain. Sneaky, not a real benefit for the investor.
Wow.
And they talked about the mischief-making powers of things like option warrants. American and foreign power warrants had a market cap over $1 billion in 1929. Pure speculative instruments, often detached from reality, potentially diluting existing shareholders massively. You couldn't just trust the label.
You'd have to look under the hood.
Always. So they proposed a new classification based on actual behavior and risk-profit characteristics, not just a legal name. 3 classes. Class 1, fixed value type, high-grade bonds, preferreds. Stable value, focus on safety, steady income. Includes convertibles where the conversion is miles away, so they act like plain bonds.
That's safe stuff.
Pretty much. Class 2, senior securities, variable value type. This splits. A, well-protected but with profit potential, like a good convertible bond where conversion is relevant. B, inadequately protected, lower-grade bonds, preferreds. You accept higher risk for a shot at higher profit if things turn around.
Okay, middle ground, varying risk.
Right. And then, Class 3, common stock type. This is anything that acts like a common stock, whatever it's called. That AT&T convertible bond at $200, traded like the stock, so Class 3. Kruger and Toll debentures, price so high, effectively common stock, even a preferred stock trading at pennies on the dollar. It's lost its senior safety, acts like a common stock now, so Class 3.
It's about economic reality, not the nameplate.
Exactly. Forces you to think about how it will actually behave in your portfolio.
That's incredibly useful. Okay, let's bring it all together. With these foundational principles, margin of safety, intrinsic value, careful analysis, looking past labels, where would Graham and Dodd likely find opportunities today if they were hunting for bargains now?
Lowenstein gives some great modern examples in his preface, showing the principles endure. The core idea is timeless. Bargains pop up when whole industries get sold off indiscriminately, usually out of fear, or when specific securities just get overlooked or avoided.
Finding value where others aren't looking.
Or where they're panicking, like the S&L crisis in the early 80s. Many solid, profitable savings banks went public dirt cheap because the whole sector was tainted. United Savings of Tacoma traded at 35% of book despite being sound. Smart investors made multiples on their money because, as Lowenstein said, people didn't understand them.
Fear created opportunity.
Classic case. Or the 1997 Asian meltdown. Indiscriminate selling hammered perfectly good companies. In South Korea, Shinyoung Securities traded below half its book value. Daikyo Corp, a tutoring company, traded for less than the cash it had per share.
Literally buying cash for less than cash.
Almost. Pure Graham and Dodd safety principle plays. Massive margin of safety. Then the 2001 energy stock slump. Drillers like Ensco, Patterson-UTI selling for less than their rigs were worth. Asset value provided the floor, the margin of safety, regardless of oil prices fluctuating.
Tangible assets.
Right. And Xcel Energy in 2002. Utility holding company, subsidiary had debt problems, dragged the whole thing down, bonds at 56 cents, stock at $7. But the core utility was solid, cash flow was there. Graham Dodd analysis looks past the headlines, sees the underlying value, double their money, not a roll of the dice, quantifiably demonstrable.
So the same patterns repeat. Fear, misunderstanding, focus on headlines instead of fundamentals.
Exactly. And it applies even to tech, which G&E never imagined.
Yeah.
Amazon, it's a retailer. Buffett bought its bonds cheap after the dot-com bust. Intel, mature manufacturer, analyze it like you would GM back in the day. The principles adapt.
That's really compelling. And Klarman's final point about patience. When bargains are scarce, value investors must be patient. Compromising standards is a slippery slope. That discipline seems key.
Absolutely non-negotiable. Patience. Willingness to hold cash if nothing meets your standards. Not trying to time the market. Value investors are bottom-up. They buy bargains whenever they appear, regardless of the S&P 500 level.
Right.
And their view of risk. It's not volatility, not beta. It's the probability and amount of potential loss. A volatile stock can be low risk if it's incredibly cheap. A stable stock can be high risk if it's wildly overpriced.
Changes how you think about risk entirely.
Completely.
Yeah.
And ultimately, it comes back to that bedrock idea. Can you sleep well at night? Are you confident your position is secure because it's anchored in demonstrable value, protected by that margin of safety? Whatever the market does tomorrow, that's the ultimate goal. Hashtag Everotro.
Wow. What an absolutely fantastic deep dive into the real foundations of value investing, from, the Depression era context right through to why Graham and Dodd's ideas are just so incredibly relevant today. It really shows how that disciplined analytical mindset cuts through all the noise.
It really does. And the core message, I think, for you listening is kind of simple but profound. The real secret to investing is that there is no secret.
Right.
It's just about doing the work.
Yeah.
Thorough analysis, focusing relentlessly on safety first, then return. Understanding that elusive intrinsic value and having the discipline, the patience to act only when the facts line up, no matter what the crowd is yelling.
It really underscores that value investing isn't just like a technique. It's a whole mindset, isn't it? Knowing what you own, why you own it, and what it's genuinely worth as a business.
Precisely.
So here's a final thought to leave you with. Seth Klarman points out that human nature's foibles, wanting instant riches, easy gains, they're certain to be with us forever. If that's true, what persistent irrationalities in today's markets right now are you maybe best positioned to spot and perhaps even take advantage of by applying some of this enduring Graham and Dodd wisdom?
Submit you on.
Definitely. Join us next time for another deep dive. Until then, keep learning, keep questioning, and keep putting these powerful ideas to work.
What if everything you thought you knew about safe investments was actually built on shifting sand? We're talking today about fixed value investments, bonds, preferred stocks. That's kind of bedrock of many conservative portfolios.
Right.
Today, we're doing a deep dive into a real classic, Benjamin Graham and David Dodd's security analysis, specifically part 2, which is all about these fixed value assets.
And we've got a great modern perspective, too, from Howard Marks, the investment legend. He wrote an introduction for a later edition.
Exactly. So our mission for you, the listener, is to sort of untangle the complexities of fixed value investing. We'll look at how these ideas from way back have, either changed or stayed surprisingly relevant.
Yeah, some are remarkably consistent.
The goal is really to equip you with some powerful insights to navigate, the promises and, frankly, the perils of perceived safety in your own financial life. So get ready to challenge some assumptions.
Absolutely. We're going to pull out the key stuff from chapters 6 through 21 of part 2, and that includes Marx's intro, trying to make it informative but not, overwhelming.
Okay, so let's start with Howard Marks. It's fascinating how he frames it, looking back to when he started in, 1965, and thinking about the world in 1940 when the book came out.
Oh, it's completely different. I mean, Marx points out things we just take for granted now simply didn't exist. Imagine no S&P 500 as a benchmark. No common terms like growth versus value investing.
Right. No venture capital, no private equity as we know it, no Bloomberg screens spitting out yields instantly.
Exactly. And even basic things like zero coupon bonds didn't exist. What we call junk bonds today, they were just fallen angels, bonds that used to be good but fell on hard times. Calculating yields was this laborious manual process.
It's hard to even picture that world. Marx talks about his first reaction to the book. It was kind of a mix, wasn't it? Like too much dogma and too many formulas, but also this vast wealth of less quantitative and more flexible common sense.
Yeah, that tension is key. The rigid rules versus the adaptable wisdom. And Marx traces this evolution in investment standards, which is really insightful.
Okay, tell us about that.
Well, before 1940, especially in fixed income, the rules were incredibly absolute. If you were a fiduciary managing money for others, you could actually be held personally liable, surcharged, they called it, for losses on individual bonds.
Wow, regardless of the whole portfolio.
Regardless. So that led to super rigid rules about what was proper to buy. Then came the prudent man concept. That was a big shift.
How so?
It meant decisions were judged based on the whole portfolio, the circumstances. An individual loss wasn't automatically a failure if the overall approach was, prudent.
Okay, more holistic.
Exactly. And then later you get folks like Harry Markowitz in the Chicago School bringing in ideas like diversification, showing that adding seemingly risky assets could actually lower the overall risk of the portfolio.
Right, the whole risk-return relationship idea.
Precisely. Evaluating performance based on risk and return. A safe investment isn't automatically good. A risky one isn't automatically bad if the return compensates for the risk. It changed everything.
So fast forward to today, Marx says we see few absolute rules. It sounds like Graham and Dodd, even back in 1940, were pretty ahead of their time, pushing against those absolutes.
They really were. They were champions of common sense over just blindly following rules. And that leads straight into their really critical distinction between investment and speculation.
Okay, how do they define investment?
For them, Marx explains, investment meant buying assets that met standards of conservatism, prudence, and above all, safety, based on their intrinsic nature. It wasn't about the return you hoped for, it was about the inherent quality.
So quality first.
Quality first. State laws back then even specified exact bond-type savings banks. Could buy railroads, utilities maybe, but definitely not industrials or street railways, often.
That seems incredibly restrictive now. Marx even said he was initially confused by G&D's sort of yes-no, good-bad statements about bonds, especially with no mention of price or yield.
Yeah, it felt almost moralistic. But here's the key insight Marx had. G&D weren't saying, don't ever buy this thing. They were saying, don't buy it on an investment basis if it lacked that core safety.
Ah, okay. So it's about the approach.
Exactly. Today, we use investing for almost anything bought for financial gain. But Marx stresses, and this is crucial, virtually any asset can be a good investment if bought knowledgeably and at a low enough price.
That flips it, doesn't it?
Completely. Think about 2007. Even AAA-rated mortgage bonds turned to junk. It proved nothing is inherently safe, regardless of rating if the price is wrong. The price you pay determines your margin of safety.
It's really cool how Marx then connects all this G&D thinking to his own firm, Oaktree, and their success, especially in high-yield bonds. The parallels are striking.
They really are. It shows how timeless these core ideas are. For instance, Oaktree's whole philosophy in bonds recognizes this basic asymmetry. Your upside is capped interest and principal back, but your downside can be total loss.
Right, so the focus shifts.
It shifts entirely to avoiding losers, not necessarily picking the biggest winners, which is exactly what Graham and Dodd meant by bond selection is primarily a negative art. It is a process of exclusion and rejection.
Rather than of search and acceptance. I remember that quote.
Powerful, isn't it? And then there's Oaktree's focus. They operate mainly in the B zone of high yield, decent yields, managed default risk. This lines up perfectly with G&D advocating working upward from definite minimum standards.
So set your floor and don't go below it, no matter the temptation.
Precisely. Don't compromise down from safety. Build up from a minimum acceptable level. Both also understood that the big risks are leverage and unstable cash flows. G&D saw that clearly with industrial bonds in the 30s, earnings just vanishing.
And Oaktree's deep dive into credit analysis.
Yeah, their multi-factor approach industry, company, management, coverage, structure, liquidity, it echoes all the things G&D were concerned about, like G&D noting that substantial size can offer some protection, or their heavy focus on interest coverage.
It's not just vague inspiration, it's direct application.
It really is. And both reject permanent investments. Oaktree reviews credits constantly, quarterly even. G&D stated flatly, there are no permanent investments. Supervision is essential.
And they both distrust market timing, right? Focusing on credit, not predicting interest rates.
Exactly. Focusing on knowing the knowable, as Marx puts it. Rigorous analysis over macroeconomic forecasting. G&D were deeply skeptical of anyone claiming to reliably predict markets.
It's pretty amazing. But Marx did point out one key difference in approach, didn't he? About looking forward versus back.
Yes, and this is a really important evolution. Marx, coming from equity analysis, applied a future-oriented process to bonds. He argued that credit risk is inherently prospective. You're betting on the future ability to pay.
Whereas G&D were more reliant on historical data.
Largely by necessity, given the tools and information available then, Marx sees that historical focus as almost a prejudice that, while perhaps prudent then, walled off certain opportunities and created profitable market inefficiencies for investors willing and able to look forward.
So principles endure, but application evolves.
Perfectly put. But beyond the specifics, Marx emphasizes the sheer common sense in Graham and Dodd. They knew prices weren't just math. Popularity played a huge role. And they warned against easy generalizations in investing.
That feels very relevant today, with so much noise.
Absolutely. And they saw that losses aren't smooth. They cluster in downturns like an epidemic hazard, not something easily modeled. Marx admired their refusal to stick to rigid rules when common sense dictated flexibility.
Some of their insights still feel fresh, too, like rejecting lots of good bonds carries virtually no penalty.
Right, the Warren Buffett baseball analogy connection, you don't have to swing at every pitch. And their focus on cash flow stability for debt service, that was way ahead of its time, basically foreshadowing the early LBO focus on non-cyclical businesses.
And that warning about real estate appraisals, chillingly prescient.
Isn't it? Their 1940 description of purely artificial valuations made for a fee to deceive the investor. It perfectly captures the subprime crisis dynamics. It's incredible. It just hammers home their core message. Substance over form, critical thinking above all else.
Okay, so let's really dig into G&D's core philosophy now, starting with chapter 6 and 7. How did they define these fixed value investments?
Well, they grouped together high-grade bonds, genuinely high-grade preferred stocks, and even some common stocks that had guarantees or preferred-like features.
But the key was high-grade preferreds, right?
Absolutely crucial. For those very few top-tier preferreds, they argued the legal subordination to bonds didn't really matter because their safety came from the company's overwhelming ample financial capacity, not just legal rights. Think National Biscuit preferred back then. But they stressed this was a tiny fraction. Most preferreds were definitely inferior to bonds.
And they really challenged the old idea that bonds were inherently safe. They called a bond an investment with limited return.
Yes, that framing is key, because if the return is limited, your primary focus has to shift. It leads directly to that idea of bond selection being a negative art.
The exclusion and rejection.
Exactly. Unlike stocks, where missing a winner feels like a loss, with bonds, you can say no to countless good ones without penalty, provided you avoid the bad ones. Their rule was absolute. If there is a difficulty or a doubt, the security should be declined. No compromises on safety.
Okay, so what were the 4 big principles they laid out for selection?
Right, 4 pillars. Principle 1, safety comes from the ability to pay, not the specific land. Principle 2, better. Judge that ability under depression conditions, not just good times. Principle 3, high coupons, high yields do not compensate for weak safety. And principle 4, you need definite rules and quantitative tests.
Let's unpack that first one, safety not being about the land. That seems counterintuitive to how many people think about secured debt.
It really does, but G&D called the traditional view a complete fallacy. Their reasoning was threefold. First, if a business fails, the assets backing the lean factories, railroads suffer appalling shrinkage in value. They're often not worth much outside that specific business.
Okay, the liquidation value tanks.
Right. Second, actually enforcing your legal right to foreclose. Often impractical. Courts hate doing it, reorganizations happen instead, bondholders get new paper, not cash. And third, the wearisome delays, reorganizations drag on, prices collapse. It's stressful even if you eventually recover something.
So the goal isn't protection in trouble.
It's to avoid trouble altogether. Relying on your lien means you already made a bad bet. The lien just tries to soften the blow.
What flows from that principle practically?
Several big things. First, for a strong company, whether a bond is secured or unsecured, a debenture is minor, an unsecured bond of a rock-solid company is safer than a mortgage bond of a weak one. Think early Standard Oil debentures.
Makes sense. Strength trumps legal form.
Exactly. Second, if a company is truly strong enough for any of its bonds to be investment grade, then all its bonds probably are. Conversely, if the junior bonds aren't safe, the first mortgage probably isn't a true investment grade pick either because the company itself is shaky.
So that leads to that idea of buying the highest yield.
Of a truly sound company, yes. If the whole structure is safe, why pay a premium for the top lien if a slightly junior bond offers more yield? They question paying a big insurance premium for only partial protection if the underlying business was robust.
But there's a caveat, right?
Yes, third point. If the yield difference between senior and junior bonds of a strong company is small, then pay the small insurance premium for the senior protection. That extra safety might matter if things unexpectedly deteriorate.
And what about those underlying railroad bonds?
Tricky. These were small liens on vital pieces of track. Some survived reorganizations well, but they still tanked in price during crises. G&D warned the average investor away, urging them to stick to the rule that only strong companies have strong bonds. It's too hard for most to pick the truly safe ones in advance.
Okay, principle 2. Buy bonds on a depression basis. Test for resilience.
The acid test, they called it. Any bond can look okay in good times, but can it survive a severe downturn? They stress that no industry is truly depression-proof. Even stable ones can dip, and that dip can be fatal if the business is bonded to the limit of prosperity earnings.
So stability matters, but you can't assume it's absolute.
Right. The key is how much an industry fluctuates. More stability allows for more debt, generally.
And their look back at the 1931-33 collapses was pretty revealing about different sectors.
Very much so. Utilities collapsed mainly due to overextended debt structures and reckless financing, not the underlying business. Railroads. Investors overrated their stability, used old standards when tougher ones were needed.
And industrials were the worst.
Most problematic for fixed value investing, yes. Collapse often came from a sudden disappearance of earning power. A good safety margin in boom times just wasn't enough protection against sustained losses. This led G&D to conclude that industrial investment should really be limited to major companies, as smaller ones were just too inherently unstable.
So, faced with that risk, what did they advise? Just avoid industrials altogether.
Their stance was firm. No consideration can justify the purchase of unsound bonds at an investment price. If you can't find genuinely sound bonds meeting your criteria, then refrain from any purchases on an investment basis.
Better to earn less on something safe than risk capital for yield?
Exactly. Accept an unattractive yield from the best bonds rather than chase a large coupon return on something shaky. Protect capital first.
Which leads directly to principle 3. Unsound to sacrifice safety for yield. This seems obvious, but they really attack the old idea that higher yield was like an insurance premium for risk.
They completely dismantled it. They argued yields aren't set by some precise math of risk, but more by popularity and market sentiment. There are no reliable experience tables for investment risk because it clusters in depressions that conflagration or epidemic hazard idea again. You can't predict it actuarially.
And individuals shouldn't try to act like insurance companies, taking on that concentrated risk.
Definitely not. The individual cannot prudently turn himself into an insurance company. Even if high yields might work out in aggregate over large numbers, the average person can't absorb those concentrated hits. Their conclusion was stark. Income return and risk of principal should be regarded as incommensurable. You can't trade one for the other.
So if a bond clearly has principal risk, what does justify buying it?
Only the opportunity for enhancement of principal. Buying it cheap, at a big discount to par, or maybe getting a really attractive conversion option into stock. The key is the buyer knows the risk and is seeking capital gains, not just yield, and is psychologically prepared for potential trouble.
Which blows up the whole businessman's investment concept of slightly riskier bonds for slightly higher yield.
Yes, they called that an illogical type of commitment. If you can handle risk, seek price appreciation, not just a bit more income. Their recommendation, again, was work upwards from minimum safety standards. Define your floor, disqualify anything below it, regardless of yield. Don't compromise down from safety.
Okay, principle 4. Apply definite standards. Use clear, quantifiable rules, maybe inspired by things like the savings bank laws.
Right. Use those laws as a starting point, but critically. They laid out 7 key criteria: nature, location, size, terms, solvency record, earnings coverage, property value to debt, and stock value to debt. A comprehensive checklist.
But they disagreed with those laws completely banning certain categories, like all industrials.
They called that a fallacy. Blanket bans weren't practicable nor desirable. Some industrials were strong, and banning categories just pushed demand into the legal ones, potentially making investors accept weaker bonds within those approved groups. Their idea was better: require a stronger showing from bonds in inherently riskier classes, tougher standards, not outright bans.
They also seemed very wary of foreign bonds.
Extremely. For government debt, it's about politics and intangible credit, not just financials. An unenforceable contract, often with a bad history. Even guaranteed foreign corporate bonds had practical issues with currency transfer and enforcing lieners across borders. Generally, a no-go zone for them.
And they emphasize size, particularly for industrials.
Yes, small companies are just more vulnerable, lacking resources, diversification. They suggested minimum revenue figures: $2 M's for utilities, $3 out for rails, $5 especially for industrials, arguing substantial size affords an element of protection.
But size isn't everything.
Definitely not. The biggest company may be the weakest if its bonded debt is disproportionately large. Size has to be paired with a sound financial structure.
Now, this is interesting. They argued property value is generally not the key to bond safety.
Right. Another counterintuitive point. Safety hinges on the company's ability to pay its debts from operations, not the liquidation value of its assets. Book values of property, often irrelevant because that value disappears if the business fails.
But there were exceptions, special cases where the asset was crucial.
Absolutely. Railroad equipment obligations were the prime example, secured by things like locomotives, movable, usable assets with independent value. The lien was actually enforceable. Plus, the debt structure usually ensured debt shrank faster than depreciation, a very strong record.
Any others?
Investment company collateral trust bonds, secured by a portfolio of other securities. Here, the market value of that collateral was key. Good indentures required maintaining collateral value above the debt, forcing action if it dropped. That protection could work really well.
Then we get to real estate bonds. Reading that section feels like déjà vu from 2007.
It's uncanny, isn't it? A timeless lesson in folly. G&D saw that most real estate value is going concern value, tied to rental income. But in the 1920s, boom,
Came the purely artificial valuations.
based on capitalizing hoped-for, often inflated initial rents, not sustainable earnings. Appraisers signing off for a fee, deceiving investors. Overbuilding followed, pushing up construction costs, making even supposedly conservative loans unsafe when values inevitably corrected.
And the type of building mattered hugely.
Yes, treating specialized buildings, hotels, garages like simple apartment blocks was a major error. These lack rapid disposability. Their value is tied to a specific business. They should have been treated like riskier industrial obligations. Plus, investors often got zero information after buying, only finding out about problems at default after owners had milked the properties.
So G&D laid out specific rules for real estate investors going forward.
They did. Loans capped at 66% of actual recent cost or fair price. Ignore inflated appraisals. Demand actual cost exceeds the bond issue by 50% plus. Require conservative income projections with big margins after depreciation and sinking funds. Mandate regular financial reporting from borrowers. Treat leasehold mortgages as second mortgages. And avoid loans on specialized buildings altogether unless they had a proven operating history. It's all about substance over misleading form.
Let's shift to preferred stocks, Chapter 15. G&D said an investment-grade preferred needs to meet all the tests of a good bond, plus an extra margin of safety.
Exactly. Because of their weaker legal standing, preferreds needed even more stringent quantitative tests. For an industrial preferred, they suggested minimum earnings coverage of 4 times total charges, bond interest plus preferred dividends, compared to just 3 times for an industrial bond. Much tougher standards.
But having bonds ahead of the preferred didn't automatically disqualify it.
Not necessarily. It is not the mere presence of bonds, but rather the amount of the prior debt, which is of serious moment. A strong company with minimal debt ahead could still have a very safe preferred Again, substance over form.
And they hated calculating preferred earnings on a dollars per share basis.
Hated it. Called it valueless or misleading. You must calculate coverage on a total deductions basis, looking at earnings available to cover both bond interest and preferred dividends combined. Otherwise, you get weird results where the preferred looks safer than the bonds, which is illogical.
What about non-cumulative preferreds, where dividends missed aren't owed later?
They thought those were patently inequitable. Directors could skip dividends even if earned, benefiting common shareholders unfairly. G&D wanted laws to make dividends cumulative at least to the extent earned. Interestingly, though, their own 1932 list of investment-grade preferreds had quite a few non-cumulative ones, showing again that underlying company strength could sometimes overcome weaker structural features.
Okay, on to some trickier structures.
Yeah.
Chapter 16. Income bonds. Sort of a bond-preferred hybrid.
Pretty much. They have a maturity date like a bond, but interest is often discretionary, paid only if earned. Historically, they had a low investment rating because they usually came out of reorganizations of failed companies. The contingency itself implies earnings might be insufficient. G&D said apply the same tough earnings test as preferred stocks and ignore misleading statistics.
Chapter 17 deals with guaranteed securities. The word guaranteed sounds great, but G&D urged caution.
Crucially, the value of any guarantee depends strictly upon the financial condition of the guarantor. Sometimes the market actually undervalued strong guarantees, selling guaranteed bonds cheaper than the guarantor's own unsecured debt, which made no sense.
So you have to analyze the guarantor as rigorously as the issuer.
Absolutely. A good guarantee ranks equally with the guarantor's own unsecured debt. It should be rated similarly or better than the guarantor's preferred stock. The terms also matter hugely.
Interest only versus interest and principal.
Big difference. G&D saw cases where interest-only guarantees were met, but principal defaulted. Conversely, a junior bond with a strong interest guarantee could outperform unguaranteed senior bonds from the same weak system. They also loved joint and several guarantees.
Where multiple companies back the whole issue.
Yes, each one potentially liable for the entire amount. They felt investors didn't fully appreciate the extra protection. They cited a terminal railway bond guaranteed by 12 railroads as a prime example, and criticized investors for buying non-mutually guaranteed bank bonds for only a tiny extra yield over fully guaranteed ones. That shared backing was vital.
And guaranteed real estate mortgages. Back to that danger zone.
Another cautionary tale. The guarantee business became recklessly unsound in the boom. Aggressive firms, lax standards, over-leveraged guarantors, often subsidiaries of the sellers. The guarantee became a mere name when the crash hit because the underlying loans were often bad.
G&D also flagged hidden liabilities like leases, things not obvious on the balance sheet.
Very important point. A long-term lease with fixed payments is effectively the equivalent of a guarantee by the company making the payments, the lessee. Some leases provided very strong backing. But you had to understand the specifics. Was the leased property actually valuable and profitable? Sometimes key negative information wasn't disclosed.
So how did they suggest accounting for these lease burdens?
They noted leases were often overlooked until the Depression revealed their crushing weight, their practical suggestion. When calculating earnings coverage, add 1/3 the annual rentals to the company's fixed charges. A pragmatic way to factor in that hidden obligation.
And the flip side. Don't assume a strong parent protects a subsidiary's bonds.
Right, the opposite mistake. Unless the parent has contractually guaranteed the debt, it might just let an unprofitable subsidiary fail, losing its own investment but leaving the subsidiary bondholders holding the bag. G&D cited a case where this happened, crashing the subsidiary's bond price. Lesson. For unguaranteed subsidiary bonds, you need separate financials for that subsidiary. Consolidated reports hide too much.
Let's talk protection. Chapters 18 and 19 cover protective covenants and reorganization. These are the legal safeguards in indentures and charters.
Right. They cover defaults, restrictions on new debt, maintaining working capital, things like that. Standard stuff designed to give bondholders or preferred holders some recourse if things go wrong.
But G&D pointed out a paradox. Invoking those rights, like forcing receivership, often hurt bondholders more by crashing prices.
Exactly. They questioned if bondholders might be better off without an immediate enforceable claim if payment was impossible under current conditions. Forcing the issue could ruin the corporation without benefiting the bondholder. It just leads to chaos and depressed prices.
This led into discussing reorganization and how laws like the Chandler Act changed things.
Yeah, the old system had issues. Friendly receivers, conflicted bankers committees, forced sales. The new laws, Chandler Act, Trust Indenture Act, aimed for fairness. Disinterested trustees, impartial plan development involving the SEC and judge, statutory fairness standards, scrutiny of committees, stronger trustee duties. G&D saw these as big improvements.
But they also proposed a more radical remedy for default.
Very radical for the time. Instead of receivership, give bondholders immediate voting control of the company upon default. Essentially, turn the bond into an income bond temporarily, postpone payments, avoid messy court fights, let bondholders manage the recovery, implemented via the trustee.
Wow, bondholders running the show.
It was a big idea. They noted similar things existed sometimes with income bonds or in Canada. They thought this could be a better remedy for both bondholders and preferreds, making the legal weaknesses of preferreds less critical than practical procedures.
What other covenants did they see as important?
Prohibiting new senior liens was standard. The equal and rateable clause for unsecured bonds, giving them a share if future mortgages were created. Working capital requirements for industrials, though G&D again preferred voting control over receivership if those were breached. And for investment trusts, strict rules on maintaining collateral value were crucial and should be enforced.
And sinking funds to retire debt over time.
Yes, very important. They increase safety by reducing debt and support the market price through regular buying. G&D considered them indispensable for bonds backed by wasting assets like mines or certain real estate. They showed how companies without sinking funds suffered badly, distributing cash to equity while bonds became worthless.
But enforcement could still be weak.
Right. Defaulting on a sinking fund payment often didn't trigger receivership because it was too drastic. Arrears just accumulated. Again, G&D thought voting control was a better answer. But even with all these covenants, they noted a paradox.
The best-performing bonds historically often had weak covenants.
Because they were the oldest issues, predating modern protections. It showed that ultimate success depends primarily upon the success of the enterprise, secondarily on the indenture terms. But, they concluded, covenants do add safety and are worth insisting upon.
Okay, final chapter for today. Chapter 21. The myth of permanent investments, that old buy and hold forever idea.
Yeah, the Depression shattered that. Gilt-edged bonds defaulted. The new canon became, there are no permanent investments. Constant supervision became necessary.
Which raised the question, is fixed value investing now more trouble than it is worth, especially with low yields?
For average people, G&D made a near categorical case for U.S. savings bonds back then, safe, guaranteed yield redemption option. They thought it would save enormous amount of money, trouble, and heartbreak compared to riskier corporate bonds.
But institutions, wealthy individuals, they still needed other options, so supervision was key.
Periodic reexamination was essential to cut losses. The idea was to switch out of weakening bonds into stronger ones, maybe taking a small loss.
But that got harder over time.
Yes, markets became more sensitive. By the time a problem was obvious, the price might have already collapsed, making switching painful or turning the holder into a speculator.
So how did G&D suggest managing that faster market reaction?
By demanding exceptional margins of safety as insurance against doubt. Buy bonds that are way safer than the minimum requirement, so safe they can withstand a huge hit before their quality is even questioned. This gives you time to switch while the price is still decent. Like buying a bond earning interest 20 times over, not just 3 times. It provides a huge buffer.
And finally, where to get advice, who to trust.
G&D were skeptical. Only pros should rely solely on themselves. Banks were okay for small investors against scams, but superficial. Investment bankers, conflict of interest, they sell securities. Stockbrokers, that push you into stocks. Investment counsel trust companies. Viable, but fees felt high for low-yield bonds.
And market timing advice.
Deeply skeptical. They saw no paid agency providing reliable forecasts. Mixing investment advice with market timing was fundamentally illogical and confusing, pushing investors towards speculation.
So what was the best role for an advisor, in their view?
The intermediate region, dealing with bonds that have already fallen in price, finding advantageous exchanges, identifying bargain issues below intrinsic value. More of an active value-focused analytical role, not passive holding or market guessing.
What an incredible journey through Graham and Dodd, with that fantastic overlay from Howard Marks. From judging safety by ability to pay, not just listens, to investing on a depression basis, rejecting yield over safety. These ideas feel so solid even now.
They really do. And that core lesson, there are no permanent investments. It just hammers home the need for vigilance, for digging beneath the surface, for understanding substance over form. Whether it's a guaranteed bond or a complex reorganization, avoiding trouble and demanding that margin of safety, that's timeless wisdom.
Absolutely. In today's world, which is just flooded with complex products and data, that core G&D message, seek common sense, question assumptions, prioritize protecting capital, it feels less like just an investment strategy and more like a philosophy for dealing with uncertainty.
Well said.
So the question for you, the listener, is, thinking about your own financial world, what hidden liabilities or subtle risks might you be overlooking just because they look safe on the surface? How can you apply this negative art, this thoughtful exclusion and rejection, to build a truly resilient financial future?